Hello everybody, this is the OctaFX Forex Fundamental Analysis for June 1st. Sorry about the issues earlier, I hope everything is alright. Today's webinar, a few disclaimers, some housekeeping before we start. The risk disclaimer: trading foreign exchange and margin carries a high level of risk and it may not be suitable for all investors. You should not invest money that you cannot afford to lose. And a hypothetical trading disclaimer: the information in this webinar is provided as general market commentary and does not constitute investment advice. Okay, so a quick presentation about myself. My name is Johay Elam. I'm a Forex analyst. I used to be a retail trader, a computer programmer, and I founded Forex Crunch back in 2008. The site and this webinar, they both focus on fundamental analysis. Okay, so what we'll talk about today, it'll begin with stories moving markets, the upcoming events, next events to look out for, especially the non-farm payrolls tomorrow, key levels of support and resistance for all currencies, and so when we talk about the dollar, we'll take a look at dollar yen, and then of course the classic currency pairs, euro dollar with euro, we'll analyze UK elections with pound dollar, and more briefly talk about the Canadian and the Australian dollars with the relevant pairs. Okay, so the big question for markets remains: to hike or not to hike in June? That is the question. If the Fed raises rates, it's good for the dollar. If they leave them unchanged, it's quite bad for the dollar. We had lots of noise in recent days. Brainard, a senior Fed member, she talked about worries about inflation, but she probably supports the June rate hike, and between the lines, after June, she would like to pause. The Fed remains data dependent. At least that's what they tell us. So if we have weak data, they're not going to raise rates. It's bad for the dollar. If the data is good for the US economy, they will raise rates. The non-farm payrolls is, of course, the key event. At the moment, markets are pricing an 88% chance for a rate hike, but there are new worries about a dovish hike, raising rates now, but pausing for a very long period of time, and the US dollar is suffering. Okay, so a bit of indicators. The Fed's favorite inflation figure drops to 1.5%. That's below the 2% target, moving away from the target, and that weighs on the US dollar. Consumer confidence slips to 117.9, weaker than expected, but still relatively high. So data is a bit mixed, and of course, once again, recurring theme is the non-farm payrolls. But before the non-farm payrolls, we have a few warm-up events. Okay, today we have the ADP non-farm payrolls. That's a private sector indicator. Not always well correlated with the non-farm payrolls, but merits its own strength because it does move markets. Okay, we also have jobless claims like every Thursday, 12:30 GMT. All times are GMT, and the last hint is the ISM manufacturing PMI. This time we have only the manufacturing one, not the non-manufacturing. Okay, and of course, first Friday of the month, 12:30 GMT, US non-farm payrolls. Wages are more important. A look to next week. Monday's ISM manufacturing PMI will move markets, but of course will not serve as a hint. So let's preview the non-farm payrolls, king of forex indicators, also known as NFP. Again, there's high uncertainty about the June decision. This could be the make or break moment. Now, the Fed has two mandates: inflation and full employment, jobs. And the best indicator for both is wages, because when we reach full employment, employers have to pay higher salaries, and this pushes inflation higher, pushes the dollar higher. Are we there yet? Not so fast, because we're still seeing big gains in jobs and wages still remain low. That means the US economy can still continue hiring more and more people. And while more hiring is of course good, there's still a long way to go. That means they will hesitate with the rate hike, and that will not be so good for the dollar. Economy is not overheating, okay? Expectations for the non-farm payrolls. We're talking about gains of 186,000 jobs gained. This could make the initial reaction. If we have above expectations, it's good for the dollar. Under expectations, bad for the dollar, but only their initial reaction. Wages are what matters. Last time we had wages rising 0.3, but they were at 2.5% year over year. This time 0.2 is expected, and we might have some expectations shaped by the ADP today, but that refers to jobs, not wages. All right. So remember, again, the initial reaction is not necessarily the correct one. So we might see the dollar at the beginning jump, but then immediately go much lower, or the other way around. It happens many times with the NFP. Okay, so what do we expect? Here are my three scenarios. If we have wages year over year, once again stuck at 2.5 or even lower, I expect the US dollar to fall. If wages rise to 2.8 or higher, the holy grail of 3%, then the US dollar would surge. It would be the smoking gun for a rate hike, the nail in the coffin, or whatever expression you wish. If we have in between that doesn't leave a lot of space, that leaves 2.6, 2.7, we might see a lot of choppiness. It will just serve as more noise, okay? In any case, trade with care. Ignore the initial move once again. It could be related to the headline. Now, let's talk a bit about dollar-yen. Dollar-yen is the most sensitive pair to US indicators, and it rises with chances for rate hike, as we mentioned. Politically, it falls when Trump is in trouble. Politics has been off the radar in the past 2 weeks, but Trump always surprises with tweets. And it falls on geopolitical worries. We haven't had that in the past few days, but remember, when we have trouble in the world, wherever in the world, it's good for the yen. So let's look at the chart, dollar-yen chart here on the OctaFX trading platform, the MT4 platform. So if we look at levels high above, we're talking about 115.50. Then we have, it's not in the chart, it's seen a long time ago. Then we have 114.30, the cycle high, as you can see here on the chart. Then we have 112.10, much closer to current levels. Okay, so we have a big gap there in terms of lines of support and resistance. Then, supporting current levels, we have 110.20, just above the round 110 level. And then the cycle low of 108.10. Okay, these are the levels to watch. All in all, you can see some kind of a downtrend in dollar-yen. But a lot of hesitance there. I wouldn't say it's a very clear move. Okay, let's go back to the slides. Now we're talking about the euro. So the big news this week was that there were reports by sources, it came from Reuters, that the European Central Bank will upgrade its assessment. We'll stop talking about risks, and if they're not so worried, that's of course good for the euro. Inflation, on the other hand, inflation disappointed with 1.4% on the headline and 0.9% on the core. So the previous month in April, core inflation reached the highest level since 2013. Now we've seen a setback. We expected a setback, but it came just a bit under expectations. But most analysts think that this will not stop the ECB from remaining optimistic. Okay? Specifically, this wasn't such a big surprise because German, Spanish and also French data provided hints for this. So all in all, we're seeing the euro moving up, euro dollar going up. One of the small reasons for the rise is that French growth was upgraded to 0.4%. Okay, politics. We had a speech by Merkel saying that Europe needs to rely only on itself. It made a lot of noise, but did not move markets. Greece, we talked about Greece last time, but now it's back to the back burner because the can was kicked once again. They're delaying any decisions, so no news. It's probably good news for the US dollar. And the polls are confident for Merkel, German Chancellor, in the elections in September, and for the French President Macron in the parliamentary elections later this month. Italy, at the moment, is an issue, but it's not in the headlines again. So, what moves will move the euro once again? We have 1 week until the ECB decision. Watch out for any leaks from ECB members. Leaks are very common. Everybody likes to talk to the press, and it moves markets. All these rumors and leaks. Tension is already high. When we have high tension, then we can see choppiness, but no big move. So we might see the charts going like this, sort of not going anywhere fast. So don't be too frustrated. Monday is a holiday in many European countries. We might see slightly lower volume. The main markets are open, that's the UK and the US. On Tuesday we have a business investor confidence, the Centix, could move markets a bit. But again, the big event is Thursday's big ECB decision. In this decision they also present new forecasts, so it's more important than the April decision. In general, euro dollar has a clear trend to the upside. The French elections unleashed the upside. Growth is stronger in the Eurozone than in the US. Politics look more stable, and now it all depends on central banks. Okay? So let's look at the euro dollar chart here on the OctaFX platform. Here we can see a clear uptrend. We have a gap here in the chart. In any case, the levels to look out for, let's start from the top, from the highs seen last September, 114.20. Then we have 113.60. The round number of 113 is a critical level. We got close to that, okay? We're not far from that, but the cycle high is 112.65. The next ones are 111.60, sort of seen in recent days, 111.20, and then we have very close by 110.75, this more the recent range. 110.20 and 109.50. Okay, all in all, we're seeing some range trading, but the trend, the bigger trend, medium term, long term, is to the upside. On euro dollar. Okay, let's move to the pound. Their politics is more important now than central banks. 1 week until Brits go to the polls. The big news came 36 hours ago. Shocking, that's how the British press described it. YouGov poll showed a hung parliament, no absolute majority for the current incumbent Conservative Party. And when we have hung parliament, we have political uncertainty, and that is bad for the pound. Other polls, on the other hand, showed a wide margin for Con. Con is the Conservatives, and that is what markets want to see. Jeremy Corbyn, his public appearances, leader of Labour, were better than Theresa May in recent days, but it doesn't mean that he'll be elected Prime Minister. Worst case scenario again for the pound is that we don't have a clear winner. And every poll matters, so basically we can mostly ignore economic indicators in the next week and look at every opinion poll. The problem is we don't know when they are released, so every newspaper has its own schedule, every TV station. Okay, just about the elections, the markets want a Tory, a conservative landslide. This implies hopes for a softer Brexit, because if Theresa May, the Prime Minister, gets a personal, strong mandate, she can do another U-turn also on Brexit. Labour, the opposition, does not offer a softer Brexit and not market-friendly policies, okay? So they are not favoured by markets, not by the pound. Watch out for the UK elections during the trading hours. We'll talk about that, of course, more in detail next week. Pound indicators, we had net lending to individuals slip to 4.3 billion, not that meaningful. Growth was downgraded to 0.2, that happened last week, but basically it's all about the elections. Again, polls, but we have a few indicators that should have a small impact. It should move markets, but for a very short period of time, okay? So we have basically it's PMI's, manufacturing PMI, Thursday, 8:30 GMT, same time tomorrow the construction PMI, and on Monday the most important purchasing managers index is the services sector, the biggest one. On Wednesday we have some housing data for the UK. Again, it's all about the elections. So the bigger picture for pound dollar so far in 2017 is that the US dollar is weaker than the pound. So we have worries about the elections at the moment, we have Brexit, weaker growth, but the US dollar is weaker because of Trump, because of other issues. We had an attempt to move so far it's working towards the initial post-Brexit levels, this wide range of 128 to 135, but I would still say that the pair known as cable pound dollar is quite vulnerable. Let's look at the charts. We had in pound dollar a drop after that so-called shocking YouGov poll, but since then we had a recovery. Again, other polls showed a more favorable outcome. So if we look from the top, beyond the current cycle, we have 130, 130. The cycle high so far 130.50, a very strong level over there. We have 129.80, just under 130, that served as resistance. 129 around current levels, 128.40, so this is sort of the current range, 128.40 to 129. 127.75 to the downside, recent low, and 127 if we break down from the current range, if we have another worrying pull for the pound. Okay, now let's talk a bit about the commodity currencies. Canada produces oil, but we had also some domestic news. So growth in March beat expectations with 0.5. On the other hand, current account it missed expectations with a bigger deficit than expected. Oil prices almost stabilized, but they're once again a bit under pressure. So it's oil prices that weigh on the Canadian dollar. On the other hand, we have good domestic data. Mention quickly the elephant in the room. More reports from the press, more analysts are saying that Canadian housing market is in trouble. A jump in house listings, especially in Toronto, worries about bankruptcies and the Ontario government curbing foreign investment. Why am I talking about one city in a big country? Because there is a very good correlation between the situation of the housing sector and the wider economy. I guess everybody is familiar with the 2008 crash. Okay, next big Canadian events. On Friday, during the non-farm payrolls, we have trade balance and labor productivity from Canada. So we might see a different reaction on dollar CAD than on other currencies. So if you want to trade the non-farm payrolls that we talked about before, don't trade dollar CAD. It could be a bit more problematic. And next week, on Tuesday, we have a Purchasing Managers Index called IVPMI. And looking even forward, the next big event is the Canadian Jobs Report, this time released 1 week after the American one. All in all, Canadian dollar had a weaker start to the year. Weak start to the year. This happened also in 2016. Since then, optimism from the Bank of Canada and from OPEC pushed the Canadian dollar higher, and dollar CAD at the moment is in a bit of a downtrend, but I would say more looking for a direction, I would say similar to dollar yen. Let's look at the dollar CAD charts, again here on the OctaFX platform. So levels from the top to the bottom, the cycle high was 137.19. That's a bit far off at the moment. Then we have 136.40, which worked as resistance quite recently. Then 135.40, 133.80. This is more or less the current range. To the downside, if we have stronger oil prices, we could expect 132.20 to serve as a cushion for the pair, and then the round number of 130. Okay, and let's talk quickly about the Australian dollar because we had quite a few events. So the biggest events came from the PMI. We had a warm-up with official figures from China. It was more or less as expected, 51.2, but the bigger news came from the domestic data in Australia. Capital expenditure came out better than expected, or more or less as expected, 0.3. Retail sales beat expectations, so Australian consumers are buying. But once again, China, Australia's #1 trading partner, has a bigger impact on the Australian dollar than data from Australia. Chinese Caixin PMI, it dropped to 49.6. Now, what does this number mean? It's under 50. 50 is the borderline, the threshold between expansion and contraction. So this is a big worry of China slowing down, not only for Australia, but for the whole world. And that's why we're seeing the Australian dollar weaker. Next week, busy week for Australia. We have company profits on Monday. The biggest event is the Australian rate decision on Tuesday. No changes expected in the interest rates, but they might give us an update about how they see the economy, how they see the Chinese economy. On Wednesday, we have the Australian GDP. We had a hint from the Treasury Minister Morrison. He gave us a hint that GDP might be a bit weaker this time, okay? So this might hurt the Australian dollar, and we have trade balance on Thursday, and also Chinese trade balance. So at times the Australian dollar is influenced more from China. This is one of those periods. Sometimes the correlation is quite weak. Okay, in general, Australian dollar is trending lower since March, late March. Currently it's off the lows. It bounced off, but it's a bit in trouble. Moves are more subdued in the past. Used to be one of my favorites, but anyway, let's look at the charts and you can see it for yourself. So the Australian dollar is today a bit weaker. Support awaits there at 73.75. Lower support at 73.25. Cycle low. Even lower if we have a breakdown, then 72.50 is the level to watch. Moving to the upside, we have the round number of 75, of course, and above that 76.10. This is a very strong line. It worked both as support and as resistance, and the high level to watch up there is 77.40. Okay, that's it for the webinar. Thank you very much. Any kind of comment, feedback, of course, more than welcome. Sorry again about the technical